Yesterday, we took a look at RIVN, the up-and-coming American EV producer. So today we're going to take a look at their Chinese counterpart NIO, as they've just reported their Q3 earnings. And let's just say things are definitely getting interesting in the EV space. We already know there is massive incentive to push people into EVs. And while we are waiting for the broader consumer base to make the switch from combustion engines, we as value investors need to see if any of these EV makers are worth investing in before the mass adoption. So make sure to stick around till the end of the video as we'll conclude with our analysis and evaluate this business. But on that note, how's it going? Welcome to Everything Investing. I hope you're having a great day. Today, as we just mentioned, we will be looking at NIO's business and earnings results, starting with the analysis of the business and then through the financials, the top line, bottom line, balance sheet. They didn't provide us with cash flow statement. We'll get into the reasons why later. But with all that information, we'll end up concluding this video with an evaluation using our intrinsic value calculator to identify the buying opportunities with NIO. And if you enjoy this type of content, make sure to smash that subscribe button because we post on here regularly, analyzing the businesses that you're most interested in. And if you have any video recommendations, always make sure to put them in the comment box below. With all that being said, let's jump into the video. Okay, and we're starting with NIO's Q3 earnings results. What are the CEO and CFO mentioning to give investors context for this quarter? Well, it's that they delivered 31,000 vehicles this quarter, and that is solid growth, up 30% year over year, achieving a record-breaking quarterly delivery. So we can already see right off the bat, this business is definitely something to keep our eye on as value investors because these are some solid growth numbers, and they're saying they're still seeing some strong growth momentum after their debut of their ET5 vehicles, which were released in stores in September, and they expect the deliveries will support a substantial acceleration of their overall revenue growth in the fourth quarter. And if we just take a quick look at their product line, they have ET7 and ET5s. These are their sedans. Then they have a bunch of SUVs, as you can see here. Okay, and their ET5s are definitely getting people excited about that. And in fact, it's actually to the point where they have been working closely with their supply chain partners to accelerate production and delivery because there have been, such long wait times for their vehicles. All right, and if we take a historical look at revenues, we can see these have actually been growing at a very strong rate. However, of course, when we look at bottom line here, it's not trending in the right direction just yet. But we always have to give a little bit of leeway when it comes to these newer businesses, especially when the entire sector is kind of just breaking into the market right now. Cash and debt is actually looking good as well. So we'll take a look at their liquidity in just a little bit. First, let's look at their key financial results here. Vehicle sales for this quarter are now at $11 billion in RMB. Okay, again, that 38% increase year over year. When we look at their vehicle margin, however, that's actually kind of creeping down just a little bit. When we look at this from a quarter over quarter perspective, yeah, it's around the same, but year over year, it was at 18% last year. So it's 160 basis point decrease. Not exactly where you'd want that to be. Now, what is the reason for those declines? Well, you can read down here. It's because there have been increased battery costs per unit, and that's mainly because of inflation. So they have to spend more on those batteries, and that's ultimately impacting their revenues, but they were still able to grow revenues up to $13 billion. That's about $1.8 billion US. And again, is that 32% increase year over year. All right. And once we deduct for our cost of sales, we're actually left with about 1.7 billion RMB, which is about 245 million US dollars. So that's definitely a positive. However, if we take a look at their gross margins, again, last year we were at 20%. Now we're only down to 13%. So a significant decline there on their margins. Definitely not in the direction investors want that to go. Obviously, in China, they have a lot of COVID restrictions still going on, a lot of lockdowns still. So that's really impacting their business. And ultimately, once we deduct for our SG&A and research and development costs, yeah, we're actually at a 3.8 billion RMB loss from operations, right? So about a 544 million US dollar loss from operations. So they're still not able to become profitable just yet. They still have a little way to go before they reach that profitability. And unfortunately, management has not let the investors know when they anticipate that will be, like some of their other competitors. But just like RIVN yesterday, they are also committed to that share-based compensation expense, where they actually had an increase of 130% from last year. And again, that's a result of the grants of their restricted shares on a continued basis, meaning they are going to be slowly diluting the shareholders. So if you're thinking about investing in this business, understand that that's what you're getting yourself into. In terms of the business outlook, for at least for fourth quarter 2022, they're expecting about 43 to 48,000 vehicles to be delivered throughout that quarter. Again, that's an increase of about 72% to all the way up to 91% if you were to compare this to the deliveries from last year. Revenues should be around 2.4 billion US dollars. Again, massive growth year over year. And if they can keep this up, yeah, it shouldn't be too long before they can start to turn turn a profit. All right, and that leads us to our balance sheet here. All right, they have about $2.5 billion in cash on the balance sheet versus their 2.5 approximately billion dollars in debt. So liquidity is not an issue for this business, at least not yet. They do have some trade and notes payable that investors should keep their eyes out on, but to offset that, they do have long-term investments as well as trade and notes receivable. So again, liquidity, not an issue for this business. That finally leads us to an interesting point here, and that's that NIO confirms production is affected by COVID restrictions, right? So what they're saying is because of COVID and everything that's going on in China, this business isn't even able to operate the way that they should be without the restrictions. So despite next quarter's, potential 91% year over year growth, they're saying they could actually be growing at higher rates. It's a very positive sign, and it's definitely not what we saw from RIVN in yesterday's video. This business definitely already has a consumer base. They're making substantial deliveries quarter over quarter, even with production slowdowns. And so if we assume that over the next few years that they're actually able to ramp up production, we could see even more substantial growth from this business. All right, so given the potential ramp up in production, especially once we see COVID slowdowns, at least in China, and maybe some broader market adoption of their vehicles, and if we estimate that they can achieve about $500 million in operating income, over the next few years, and if we require a 10% return, we don't expect them to pay a dividend just yet. This is only a $17 billion market cap. If we expect initial growth of just 5% for the first 5 years, and then once production really ramps up, there's broader adoption of their vehicles, etc. On a 35 PE, the stock should be worth about the $10 that they're currently trading at. Again, that's just with $500 million in operating income. Right now, they have about $250 million in gross profit. So assuming they can cut down on some research and development and SG&A, they should be able to reach profitability over the next few years, at least to some degree. And then if we look at this from the best case scenario, let's say they can actually grow at 10% for the first 5 years. And with mass adoption of their products, they can start to grow at 25% for the 5 to 10 years after that on a 40 PE. Yeah, the stock should be worth about $21 per share, a double from where we are right now. And again, just with $500 million in operating income to start with. Finally, in the worst case scenario, if we expect, further COVID slowdowns in China, they miss on their deliveries, there's less adoption of their EV vehicles. For the first 5 years, they have about a negative 5% growth rate. That eventually levels out at 0% on a 25 PE. The stock will be worth about $2 per share in the very worst case scenario. I highly doubt this comes to fruition, but it is still definitely a possibility. That being said, if somehow they're able to achieve about $1 billion in operating income over that same time period, we can see how this would really impact the valuations here. Yeah, in the best case scenario, we'd see the stock all the way up to $43 per share. And let's be honest, with a market cap of $17 billion, this stock would skyrocket if they could become a profitable EV business. And if we take a look at the stock chart, they were up to $61 when there was mass optimism in this stock just back in 2021. So let me know your thoughts in the comment box below on where you think this stock goes. Is it a better alternative to RIVN, or are the best days behind us here? Again, let me know your thoughts on the sector in the comment box below. I'd love to hear your thoughts and point of views. But that being said, that's my analysis on this business. Will we see massive growth from here? Will they have a slowdown? I'll leave that up to you. If you've enjoyed this video to this point, make sure to like, subscribe. It definitely helps out the channel. And with that, I'll catch you on the next one.